Okay, hello everyone. We're still waiting for them to join.
No worries.
Let me check this. Okay, cool. Okay, we have people joining in, and we'll wait for 1 more minute, and then we're going to go with introductions.
Sounds perfect.
Hey everyone, thanks for joining. We have 10 people watching for now, and hopefully we're going to get more. Okay, welcome to the Idle South webinar series, the show where we deep dive into what it takes to build and scale and sell startups in today's fast-moving environment. Today's episode is a special one. Our guest is fresh off the heels of the successful acquisition. The marketing and analytics agency he founded was just acquired early this year, and we'll unpack how they built the product and how it truly solved the pain point and what really worked when acquiring new customers and smart decisions they made around hiring, scaling, and eventually exiting. We'll also talk about what's next, a pivot to SaaS plus services business, right, Will? And even the launch of new small business firm. Let's get into it. And today we have a Will Freeman. Will, would you mind introducing yourself?
Yeah, happy to introduce myself. I appreciate you inviting me here. It was great to see you earlier, this month, or I guess technically last month at this point, at some events in the city here. But yeah, very brief introduction of my background. Right now, really kind of classify myself as three things: both a startup advisor, a builder, and an investor. We'll talk more about what that looks like down the road. But ultimately, a lot of the things I'm doing right now spurred from things I've done in the past. And one of those things was founding a business. It was Freeman Consulting Group, a marketing analytics agency for nonprofits. I recently had that acquired as of February of this year, and have learned all kinds of things through that experience, which has led to building a SaaS platform, as mentioned, in addition to continue to advise startups and also looking to actually acquire startups and scale them as well. So more to come in terms of what that all looks like, but excited to be here and hopefully share at least a little bit of insight that proves helpful to the audience today.
Awesome. Yeah, good to hear that. Obviously, you've been in the startup trenches as a founder, advisor, investor, and the conference event organizer. In your opinion, what's the first thing a founder should get right when building a startup in 2025?
Yeah, it's a great question. And I think it's my answer is actually probably something a lot of people have heard if they've ever taken a public speaking course or given advice as relates to anything when talking to a group of people. It's understanding your audience, right? As you think about when going to market with a solution, it's easy to kind of go into the market with a solution in mind and then trying to find the audience that you're going to help fix a problem that they might have. But in actuality, you kind of need to work it backwards and understand your audience, understand their key problems, and then start to find solutions that therefore answer and address and ideally solve their problems. And so, my recommendation for those initially starting out is definitely understanding the audience is the key piece, but then also validating that your solution is really solving their pain points, right? There's various ways to solve problems. There might be tons of different problems, and maybe the problem that you're trying to solve is not the key problem. And so understanding that audience, going to validate that your solution is valuable for that audience, and then being able to recognize it's okay to fail and pivot, right? If your audience is, what you thought initially with maybe smaller businesses and you actually are better off supporting growth stage businesses, you find that out, you find your solution and you're able to support them. It's a lot easier to find that out and kind of pivot early on versus later on when you're getting pushback from investors or others. that maybe the market you're in and the solution you're offering isn't exactly where they need the most support in the marketplace.
Awesome. Yeah, thanks so much, Will. And by the way, for attendees watching, we have a Q&A section in our webinar where you can drop questions anytime during the event, and we'll get to them at the end of the webinar, and we'll try to answer them all. Thank you. Yeah, looking back, if you were to start from beginning, right, and what will you do differently since AI is a big thing right now, and you started your business like a long time ago, like a few years ago, when AI was not that common. And can you maybe like give a brief advice like how AI play could make businesses more scalable and valuable?
Yeah, and it's kind of unique to say, oh, it's a long time ago in this space, but it really does matter when you're in the technology space, because I mean, less than 2 years ago, the topic of AI was not top of mind versus people that are in industries. My dad did government consulting for many years, and people have firms that are hundreds of years old and they're still solving the same problems. So in terms of my the company I started, Freeman Consulting Group, I started at perfect time. It was May of 2020. So right in the height of COVID. So a little over 5 years ago, or right at 5 years ago at this point. And the way we were supporting a lot of nonprofits was more of like an extension of their team analyst support, right? So we were doing a lot of front-end support with data visualization, reporting. We were doing some back-end stuff, but largely it was related to website analytics, because at that time, and still continues to be the issue, where the idea of analytics is not as democratized when it comes to nonprofits. And so making that more common practice and making that a little bit more efficient. And so when I say that, back in the day of when I started this, a lot of Excel and a lot of just kind of very mundane work to be done, but people needed the work to be done. They didn't necessarily have headcount to do it, so they're willing to pay people. Nowadays, that still unfortunately kind of is the case, where there's a lot of disparate systems, a lot of it, spreadsheets, even working with some of the largest, global nonprofits. But there's a lot of opportunities to focus on how can we create at least automations internally. Of even in the past year or so before selling my company, I was able to start to use AI to streamline reporting. And ultimately, it saved me time and my team time, so we could focus more on providing higher value services to the client. So what used to be a real big focus of this space of providing very technical, very tactical support of developing, dashboards or developing, Excel reports, can now be thinking about more forward-looking strategy. So instead of focusing so much on that, it's all right, how can we use this information to inform our strategy? Maybe it's we can use AI to better optimize copy on our website to improve SEO, right? Topics that were not as commonly discussed back in the day. It was more of reporting the past, versus now it's like, all right, how can we predict? How can we inform what we'll do in the future by creating those efficiencies, and also using AI to create scalability internally as a team by being able to do more with less, and also by helping our clients by allowing them to be above and kind of further down that maturity level of analytics, where especially in those industries where they tend to fall behind in that space.
Okay, yeah, it makes perfect sense. Yeah, it's definitely the environment is changing, and being the AI first company is giving you really huge advantage when it comes to like competing with more like traditional startups. Yeah, finding your first customers is like often the hardest part for founders, especially founders who's not coming from sales background or marketing background, right? And I myself, like coming from technical background, and I know it was like really challenging for me to win the first clients. And how did you win your early clients, and what advice would you give to aspiring founders to do, and what can they be doing, something that scales?
Yeah. It's very different when talking to founders. And I was just reflecting with a community leader in this area about, starting a services versus a product-based company. He, started and sold a services company as well. And one of the things is, especially early on, getting those early stage clients, right? When you think about, product-based companies, there's so many various ways to generate revenue and so many ways to really take a freemium approach of allowing people to get a taste of things and then converting them. So fundamentally, I was like, all right, this idea of giving a little bit of something and then asking more in return is really something I wanted to see how we could leverage in the services business, but it proves more difficult, right? But it's so important, especially when you're getting started. Like, you don't have necessarily a name name to a reputation to your name yet. And so how can you build up that reputation? And it's oftentimes by allowing people to get acquainted with you in a free or low cost way, and then, upsell them. And so how I actually started my business, and fundamentally, I love nonprofits, and that was a reason why I ended up working with them. But really, it was because that was a lower barrier of entry space to get into. Like they're less advanced in terms of analytics, so you can go in and add a lot of value. And B, you're able to actually provide pro bono work to some clients and then use that as a way of lead gen. And so there's various platforms out there like Catchify or Taproot. All of these are like marketplaces for nonprofits of all sizes to list essentially project listings to get pro bono support on. And so during 2020, I started the company in May, and throughout the rest of that year, in the beginning of the Q1, I was all about, and this whole mindset in the marketplace was about, all right, giving back to those that, need help the most. I was doing that because at the time I was working at LinkedIn and I was in a position I could do that pro bono. And so I started to do pro bono work, and it started off with Habitat for Humanity International. It was our first pro bono client, did a handful of hours of work with them. And then within a couple of weeks, signed a 6-month agreement with them. And then year over year have signed agreements. They were our first and largest client and are still our client after 5+ years later. And they've grown in size. And I was able to use that to acquire our initial clients by using the kind of freemium approach by offering free services and then converting to paying customers. And then also this is a very niche industry. So once you're in with some of the bigger ones, there's a lot of word of mouth opportunities, whether that's, projects with various teams within the broader organization or with others in the space that they're connected to. So word of mouth, freemium kind of approach is really valuable when trying to get your foot out there to show you have the experience and show you have a portfolio of work that people are trusting you to be their trusted advisor, especially when it comes to things like analytics.
Okay, makes sense. Yeah, and obviously, like marketing is tricky, right? Some advisors say that if your one marketing channel works, you have to keep focusing on that. And what were the marketing channels that actually worked for you, except like the things that you mentioned? And which one did you ditch early on?
Yeah, I mean, when you think of the marketing channels that I leveraged, again, like when you're thinking of like paid advertisements on like a social media platform and someone's trying to sell you a service, that can work. But for me, it was the service itself, analytics/technical consultancy. It's often more so from referrals, or, you have seen their work in practice and you kind of say, hey, they know what they're doing, versus someone in, let's say, the e-commerce space, which I worked in for many years, which can convince me to buy, some lotion or whatever that is a hot topic because XYZ celebrity recommended it. So I think the industry in general, it definitely leans towards word of mouth and kind of, kind of showing what you actually have done in the past and using that to your advantage. I would say that if you're working in the space, but not necessarily with nonprofits, then there's a little bit more creative marketing approaches that could be done, right? If we're working with startups, 100% agree that like outsourced MVP support 100% should be used in social media campaigns so you can get customers that way. What we found was our target audience being global nonprofits, they weren't necessarily on a social media platform, especially those that we say, see a little bit more ads with to get, leads for, outsourced support or anything like that. So it was really close vested in terms of, who we ended up working with intentionally, because we developed those trusted relationships, long form relationships, and that helped us expand that business with those organizations, in addition to expanding to others in the space through referral and word of mouth recommendations from our existing clients.
Yeah, makes sense. That actually totally makes sense, especially the services part, like it's all about things are different in services business than in SaaS, and we should definitely keep that in mind. So you worked at the corporate also, but you also worked at the startups in many stages. And how do you know when it's time to like raise capital, or I would rather keep bootstrapping? And what are the signals that founders should take a look at, except budgeting and and cash burn, obviously?
Yeah. Again, I kind of voice over the differences because I remember when I was starting a services business, there's a lot of literature out there about starting a product company, and the mindset of raise, exit, IPO is I don't want to say unfortunately, but it's highly ingrained in those that are product-based companies. And sometimes they raise just for the sake of fundraising, but sometimes they base it off of, actual, hey, what is, our run rate or whatever it may be, or runway that they have or burn rate, all this kind of more technical elements that I think is really important. So as I think about how I thought about my company, I actually bootstrapped it entirely for 5+ years. A lot of that was because I was working a high paying corporate job and I was able to, be self-funded. But then also it's like we had extremely high profit margins. So we were delivering work and there was no overhead practically. When we were using contractors, there was obviously overhead there, but pretty low overhead. So we were able to be self-sufficient, which was important. But if someone were in the position, whether it's product or services, and they had the kind of question to themselves of should we be fundraising, I'm a very pragmatic person. So I would say that like what I would look at it, and there's various calculations out there, but it's looking at runway, right? Whether you need 6, 12, 24 months of runway to get you to that point, whether it's to get customers that will make you self-sufficient, whether it's, getting to that next point, and then using that to inform your raise, right? So I'm not I'm a proponent for fundraising when it's needed, but I don't recognize necessarily the value of fundraising for the sake of it. And so using an informed metric like runway to say, hey, how much does it cost for us to stay in business until we can get to that next level is what I would recommend for funding. And then also it's like the buyer, or not the buyer, but the investors too, like thinking about, all right, what are the actual value added pieces of getting an investor? Getting, $500,000, $1 million from one investor versus another, there could be contingencies at play. So making sure you look at the big picture as well when looking at fundraising. Some of it might be more debt financing versus, equity versus loans. So a lot of options out there, but it can get pretty confusing for those not familiar.
Yeah, 100%. I totally agree. And there are some things that you have to keep in control more than others, right? And in your case, like, how did you keep the burn under control while still pushing for growth? Like some teams allocate like.
When you think about, 1 second, I think, are you able to hear me okay?
Yeah, I can hear you.
Okay. Sorry about this. All right. I think we're back. Can you say something again?
Yeah.
All right. I don't know what I have an external microphone and my speaker went to the microphone. I didn't even know that was possible, but I got a notification. I'm like, that's not good. So you're talking about burn though. So as you think about burn, like with a services company, fortunately my overhead was low because you're not, cost of goods are practically just the individuals doing the work. We did no paid marketing or anything like that. We had nominal costs to kind of eat. That said, when you think about, that point of scale, I ultimately leaned on a lot of contractors to help me scale because the skill set I needed was more project-based versus always on. And so those became, definitely an element to the burn rate that I wanted to account for. And there was times where I would be like, hey, does it make sense in bringing on contractors, or does it make sense to do it in-house? And a lot of that was like, all right, do we have the profit margin to justify it? And ultimately we were able to increase project sizes because we're delivering higher value, larger deals. And that's when we'd pull them in. So it made sense. So I would just say like burn rate, a lot easier to maintain as you think of a services company because of lower overhead. But when you think of those strategic decisions that are going to help you scale, you got to obviously, think about profit margins and overall bigger picture considerations as well. And that's what we did. We ultimately leveraged them. And when it came time to sell, it actually was a good indicator because we showed buyers that we could provide outsource support on projects. So if I were to step away or whomever, someone else could lead the actual execution of the work. But then we also kept, strong profitability, which is obviously important for them.
Yeah, totally makes sense. When it comes to contractors and our company, ILSoft, also helps companies to connect with top-level global technical talent. And as we know that hiring can make it or break a startup, right? And how did you decide which roles to keep in-house versus which roles to outsource or partner with software development firms like ILSoft? What worked the best for you at different stages of your growth?
Yeah. So I'll give you the context of Freeman Consulting Group because that was a different scenario than the one venture I'm working on now among a couple, which is Skyview Ventures, which is a SaaS platform. And so for Freeman Consulting Group, called it FCG for short, it was largely just myself as like the full-time headcount, but we were using upwards of 15 contractors at any given time. And the reason being was, when you're in the consulting space, it's so project based. The need, as I was kind of mentioning before, it was project related. Like we were having at a point quite a diverse range of projects we were supporting. So this one person that was a one-stop shop might not have been the person that should be doing the front end, back end of certain things, or has familiarity of one coding language versus another, right? And so we ended up thinking about contractors as a way of scaling by also maintaining. I kept 100% of equity. I didn't have to get on funding to hire full-time headcount. And the reason being was we aligned the sourcing of contractors with projects. And so we were able to capture their cost, still build in strong profit margins and stuff like that. So we scaled by using contract model, which works well in kind of the small, medium consulting space. What I ended up now starting to do with Skyview Ventures, which is essentially an AI-powered exit prep solution for small businesses. So think about it like TurboTax, but besides the tax return, it's the business listing. A lot of these businesses sub $1 million are trying to sell, but they might not get the support of a broker. It might be too pricey. And so I mentioned that because that's a very different business. It's not, there's services element to it, right? But you're not a consulting firm. And as we think about growing that, there's a lot of value of having that more always on support like a headcount would provide, and also more of that strategic conversation. And so right now I have a 6-person team, including myself, with essentially we have advisors that are on that on the team right now that range from VC-backed founders, one of which is in the AI space, which is very well connected to what we're building. And then also some very esteemed corporate execs, including the former head of product of Nike, among others. So for that, those conversations, less tactical, more strategic, and it makes sense to have that, those people around on a more recurring basis and a more generalized basis versus on, a consulting firm where you're just needing people for, execution of project work, which could be more diversified with contractors.
Yeah, it makes total sense. It's obviously should be a good balance of people in house and versus contractors. Obviously, you will want to outsource everything, but eventually you start bringing people in.
Yeah.
And for early stage startups, that's the only way to keep the product growing. Because the contractors are usually helping you a lot, especially at the early stages. And then as soon as you get funding, as soon as you get some revenue, you start bringing people in. I think that makes total sense. Another controversial topic that I want to talk about is the future of software development, right? And with AI coding tools, the developing a software is never been easier. Do you see the company's headcount when it comes to software engineering departments, IT departments, will go down eventually, or how AI will obviously influence the hiring market for software engineers?
Yeah, it's interesting. In terms of the headcount, when you're looking at larger companies, you still oftentimes have, subject matter experts in the development space. They might have specialty in either front or back end or different coding languages. And I still think that variety still exists, right? When you even look at like no or low code solutions, there's different platforms out there and they're kind of like different programming languages in their essence. And so there's a learning curve that's required. And I think that's one of the big misconceptions when it comes to, this low code, no code, AI kind of, trifecta of kind of resources now at our disposal that seem like they can just solve all the problems, but there's still a lot of learning curve that comes with those, although much less, but it's more so like, how is that adoption going to, play out? So I don't think, headcount will definitely, you'll see some fluctuations there, but what I would see is actually the kind of skill set of the headcount will shift to these newer solutions in the marketplace. And similar to like how I was talking about a little bit earlier of, hey, if I were to start a company again and keeping in mind AI, like it'd be a little bit more, focused on strategic value versus tactical value. I think that's what these development teams are going to, evolve to, right? So maybe they're spending half their time or not less in the actual development piece of it, but then they're actually also serving as, technical project managers as well. And they're able to say, hey, this is how this is transforming to business value to the clients. And so that divide that sometimes exists between the back end kind of, coding team and developers and the front end commercial teams, can be even further integrated in theory, as the technical skill sets and commercial skill sets can, in theory, be owned by similar people, given the barrier to entry is a little bit lower with these new solutions. So it'll be interesting to see how the ecosystem evolves. I think there's always still going to be a need for the people that are, currently in the field of development, but it's just what their focus area is and what their domain expertise is. I think is going to evolve.
Yeah, totally makes sense. Every founder is different, right? Some founders aim for potential exit in 5 to 7 years or 5 to 10 years. Some founders want to keep it tiny in-house, fully bootstrapped. And some founders want to do IPO. Some founders want to be acquired, right? At what point did you start thinking seriously about exit? And what did you do differently once it became a real goal?
Yeah. I think one of the things that's really important to keep in mind, and I write for Forbes some, and I have an article that'll be coming out shortly that is exactly this. I think the byline's like 5 indicators it's time to sell a services business. My editor is going to make that a little bit better in terms of like how that reads. But in essence, some of the biggest things that I knew it was time was just starting off like looking at it from a personal level. Hey, is this a space I want to stay long term? Like I exited the corporate space in November of last year in 24. And so I knew I wanted to do entrepreneurship full time. But at that point, I was already doing like technical consulting, which this was in the space of, and I was working at another company full time. I didn't want to do that full time anymore. And so I knew that I wanted to shift my focus to instead doing technical consultancy for, the services business I had, the marketing analytics agency. I wanted to support startups in new and different ways, through investing, advising, so on and so forth. And so once I kind of realized on a personal level that I probably didn't want to do this full time, I was thinking of like, what are those exit strategies or what are those exit options, right? And what I started to realize was, when, especially coming from a services business, like you're thrown into this ecosystem of M&A or just exits, and it's a lot of product-based companies. A lot of them are selling them for, not overvalued, but high value prices. And so the marketplace is very different than what I ended up selling my consulting company in, which is more of that small market, ecosystem, where these are companies that are, sell for a couple $1 million and below, but there's a big market there. And so what I ended up doing was just exploring the market and seeing that there's an appetite for these type of companies. And, there are certain things that obviously like we were already well positioned to be good in front of buyers, high profitability, good revenue, stable clients, which is especially when it comes to services important, because there are a lot of buyers are concerned of, churn, or there's a concern of the clients leaving. But we have clients like Habitat, for instance, been with us for 5+ years. We integrated things like recurring revenue to ensure kind of predictability and income. So financially and operationally, we were using contractors to outsource and still maintaining profitability and maintaining strong operations. So it was looking good from them as something that, yes, it's not as, easy to pick up as a product company, but still there's some predictability and there's proven frameworks in place that allow it to run on its own. And so I had a good company that I knew people were interested in, and it was just a matter of talking to buyers. There's a lot of there's 2 really buyers in the place. It's those that are looking, there's never a passive investment, but more of the investment minded buyer, where they might put it into a portfolio of various companies and have other intentions for it. And then there's the strategic buyer, which is likely already playing in a similar space. They're trying to expand their capabilities and resources by bringing you on. And I ultimately was able to find that strategic buyer. And so after numerous of conversations, finding that buyer was the right one. And then the deal was great, but paid over asking, paid an all cash deal, which is, not common. And they had a very clear path of what they were trying to do and how, FCG would play a role in that. So right place, right time. And fortunately, I built a company over the years that just caught their interest, and the rest is history.
Yeah, yeah. So happy for your success. I know you work hard for this, and it's always nice to exit with a good amount, which is obviously indication that you're a great founder with a lot of knowledge. But with other founders, if they want to aim for exit, let's say like make it acquisition ready startup in 3 to 5 years, like what will you do differently, and what would you advise them to do?
Yeah, I mean, when you think about, and this is actually, what my company Skyview Ventures is working to build, it's that business listing, or they call it a SIM, all those acronyms that they can, throw at you in the space. But essentially, it's like a business listing. It's like a job application that you put out there. It's like, all right, what's that kind of criteria of that ideal person, right? You kind of do it the inverse. It's like, all right, this is my business, financially, operationally, growth opportunities, all this stuff that they want to know from a buyer perspective. And so, there's fundamental things like, financially, it's like, hey, like, especially if you're a product company, like they're going to want a revenue generating company, and they're going to want to see profitability. That comes later down the road for profit-based companies, but that can come pretty quickly for services. So making sure that that is strong, and, being able to scale by maintaining profitability. So being able to bring on headcount, or whether it's, outsource talent. The recurring revenue, I think, is one of the biggest things. That's a big green flag for a lot of buyers. It's because there is that unpredictability with services. And so by creating that sense of some, predictability and income or revenue, it's really good. Other things too, it's like, don't get so distracted by the financials. Obviously, those are extremely important, fundamentally why someone buys your company, but also the operations too. Like, are you in a marketplace? Like when you're selling, like the reason for you selling, it shouldn't be that the marketplace is saturated or that you just flopped, right? You should be it's kind of when you're like applying for jobs, like apply when you have the upper hand, right? This is a marketplace where there's high growth potential. There's a lot of opportunities. So doing things like a SWOT analysis to not only reflect on your strengths and weaknesses, but especially those growth opportunities. Because when people buy companies, and that's one of the things I'm working to do now, buying smaller businesses, we're looking for those that are in industries that are niche. They're providing a solution that solves a really critical problem there, and they're able to do that in a scalable way. So as we think about those industries, like we don't want it to be an industry that there's not much growth potential. We want to see that there's a lot of gas left in the tank, and we can go and expand it. And same thing, all buyers want to see. So that's the biggest thing. Like, and then like, as mentioned, like, no, not all deals are great deals. Not all money is great money when you're raising or exiting. So not necessarily what you can do to prepare, but when it's time to exit, like you might have all these appealing offers come your way, but whether it's the financing structure, as I mentioned, I was fortunate to do all cash deal. You don't see that in much larger exits because they're getting traditional, kind of financing into play, and there's some risk inherent to that. Also, there can be a lot of contingencies that are, that they essentially could take back the money if XYZ doesn't happen. So making sure you recognize the full picture of that exit opportunity is important, because you would have built a company that you are proud of and put a lot of hard work into, and you don't want it to not necessarily have the longevity that you're hoping to see.
Yeah, thanks so much. Thanks for your answer. Last question before we dive into Q&As. Let's talk about your new venture, like SaaS plus services startup. And I know you're exploring small business private equity. And what are your plans, and what excites you the most, and what are your in general growth plans, and who's your customers? Let's talk about that more.
Yeah. So as I was talking to a colleague, friend in the kind of general space, private equity also, and kind of startup consultancy, and we were just, we've been so focused on, hey, we're working on certain things together. We talk about that. We haven't taken a step back to say, hey, what have we been up to recently? And we both were very similar in taking a generalist mindset of having our kind of hands in various things. And so really right now, from a builder side, building Skyview Ventures, the founder and CEO of that, we're actively working to develop an MVP, and we do have a pre-seed round that's open on WeFunder that we are raising for. Again, very pragmatic. We're only raising like $250,000 because that's the money that we feel as if was appropriate to get us to that first milestone. So that's a big focus, building, raising there. And then the other piece is the advisor and the investor. So I'm the managing partner for, it's called Catalyst Advisory and Capital. And so from the advisory perspective, I mean, we do things ranging from community planning. I'm organizer for Techstars, also for Synapse, lecture, like very well connected in the space. And there's a lot of value of companies getting more connected in the space, so playing the role of connector there. And then also things all the way up to exit planning, right? Especially in the small business space, but then things in between like business strategy and, marketing strategy, whatever it may be. And then also the investment piece. So the advisory piece is that, and then the capital piece we look to acquire, those smaller businesses, usually more of the services businesses, because we want them to be profitable businesses. And that path is a little longer for product. And there are those companies that are, potentially generating like 6 figures in revenue, but maybe the founder is burnt out. Maybe there's medical reasons, whatever the reasons are to step away, or even as the technical side, maybe they have great IP. They haven't been able to fully commercialize it. Maybe their background is more research and not commercials. And so they want to step away to do something different. So we're looking to actually acquire companies that are in that space to then help grow them and ultimately, maybe combine them with other companies to create a kind of broader offering, or just, in general, help them scale to a point that they haven't been able to achieve so far. So really kind of advisor, builder, investor, and then continue to give back to the community through guest lecturing, write for Forbes, board involvement, a little bit everything. But yeah, it's a little bit about me, but there's so many things you can kind of explore in terms of like websites of companies I have, but probably the easiest centralized place is just to check out my LinkedIn. If you type in Will Freeman, you'll likely see that, or you can type in like Will Freeman Forbes on Google, and my stuff will pop up. You could also get access to that, but you can see a little bit about what I'm up to, and I will have that article out soon on Forbes. So if you want to read that in greater detail about those indicators and kind of reasons I knew it was time to sell, that should be coming out in the next couple of weeks too.
Awesome. Yeah. Thanks so much. And we wish you best of luck. And I wish you best of luck personally. I know you'll do great in this venture. And yeah, happy to support your success. And hopefully we're going to meet again in 3 to 5 years. And so we can talk about this acquisition too,
Yeah, well, hopefully we see each other sooner than that. But yes,
yeah, yeah, sooner than that.
Yes, no, I love it. Yeah, I appreciate you
sure.
Having me on, and happy to address any questions from the audience.
Yeah, thanks. Yeah, we have a few questions from the audience, and the first question is, what's the biggest mistake early stage startups usually make?
I think it's one of the biggest mistakes is kind of hitting on the original question you asked. It's not being able to accept failure, or being able to accept it, but not like doing what you should be doing with it, right? And so I'll give you an example. I organize Techstars, so they have broader accelerator programs. I do specifically their startup weekend, which is a 3-day business hackathon. And over the course of this past one, which was like the second week in March, so it's just a few weeks ago, we had ultimately 6 companies that were created over the course of the weekend, which is crazy. Went from idea to a business within less than 3 days. But this is the same theme from last year too. Like we always hit that one business. In this case, it was a business that came in with one idea. They were going to be like a sales AI solution, and then ended up becoming a company that was like haptic noises to notify those with various speech impediments, just kind of cognitive disabilities, to help them immerse in society in an easier way. The reason I mention this is because they, within like a day into it, realized that the business that they created was high competition and wasn't necessarily something that they could be differentiated in. And so they completely pivoted their business to this new company, which they had called Q's. And the company ended up winning the whole competition. And it was because they had the day of, all right, let's do some market validation. And they realized that, yes, their idea was good. I actually was advising a company in a similar space. So I was like, all right, there's already competitors even in Tampa. They completely pivoted. They ended up refining something that was completely different, ended up winning the competition. And it was because they recognized that, hey, after doing validation, this might not be the most value additive thing for the broader market. Let's do this instead. And it can lead to great success. And a lot of companies don't do that ever sometimes. And they have middling results because they're servicing a smaller need or smaller market. Or they just don't do it early enough, right? And so if they do it too late, then there's, you start to get all this headcount, right? Making a business transformation that large later on can be a lot more disruptive than early on stages. So fail fast and learn, and being able to learn from it is an invaluable skill, and takes a lot of courage to be able to do that and face failure, but then also kind of overcome it.
Yeah, iterate on feedback and be flexible.
Yeah.
Sometimes companies pivot in the middle of like huge funding period, or even like in the hyper growth stage. Then there's nothing wrong with pivoting and iterating on feedback, because all you have to do is serve customers, and if customers love your startup, then you are in a good position.
Right. Yep.
Second question is question to Will. From an investor perspective, what key factors make an AI-driven startups more attractive for funding?
Well, I would say, especially when it comes to AI, like I'll use an example, that event, the Techstars event, the way it's structured, we had 15 or maybe 16 people pitch ideas. And then the audience even actually voted on the ideas they wanted to move forward with. And so out of the 16, we had 6 business ideas that were chosen to move forward with. And even just when hearing them, you heard a lot of AI company ideas, right? It's the hot buzz topic, which is great. But similar to anyone that like is trying to play in a noisy space, it's easy to get buried and get lost in that. So, what I would say fundamentally, like even not even thinking about the financials necessarily, but just fundamentally your business idea, business model, like how can you differentiate, right? Oftentimes, and there's obviously tons of literature about, how you can differentiate, whether it's product offerings, whether it's price, like it's hard to be price competitive in the AI space when there's so much open source stuff. And so really it is differentiated, value additive solutions that you can bring. And a lot of these AI solutions are in theory kind of unique, but at the end of the day, they are pretty duplicative in a lot of ways. And so making sure that your offering is unique and value additive to both sides. And there is a path to profitability, right? When you're talking about the open AIs, like they're building a lot of this stuff with the intent of not necessarily reaching, profitability for a while. And that's okay because they're, well funded and have a lot, larger budgets. But for smaller companies, especially those looking to raise, there is that element that needs to be in play of, hey, this is a good idea and a good niche, but it also is an idea people are willing to pay for, which is the ultimate, kind of way of validating an idea, and also one that we can create, profitable business out of. So I would say those two things: financials is profitability, keeping that in mind, even though it's hard to kind of keep that in mind early on. And then also just making sure you find your niche and have a value additive solution in a marketplace that is so noisy, like AI.
Okay, yeah, thanks so much. Yeah, I appreciate your answer. We have a question about finding your first customers, but which we already answered. So we're going to skip that if you guys don't mind. We'll upload this video to different channels so you can go back and listen to what we've been talking about before. We have a CEO of a company called Adgam, AI-powered proof leadership hiring, a $52 billion market, and networking with expert interviewers from global giants. The question is, shall we position it for leadership hiring or general hiring?
Got it. And what is it a sourcing?
AI-powered fraud-proof leadership hiring and networking with expert interviewers from global giants.
Yeah. So, I mean, I don't obviously know too much about the business, but I'll tell you this. I, in a past life, worked at LinkedIn and actually hired for LinkedIn for a period of time. It was a rotational program. So I was hiring sales leaders across the world. And obviously I've hired people at my companies and hired them at other companies too. And I would say that the process is very different, right? When you're thinking of more individual contributor, practitioner level, even as you start to get leadership, but especially executive leadership. I know people that have had successful careers in executive search, which are, those more C-suite level positions. And it's a lot more hand-holding, a lot more word of mouth, a lot more white glove treatment when it comes to the recruitment process versus a general practitioner. So I mentioned that because AI and everything is great. You're going to have a lot of pushback trying to leverage that. I mean, you can use that complementary to what people are doing already, but it's going to be a tough market to break into, actually, use that solely to source, senior execs. Now, when it comes to practitioners and everything like that, there's definitely a lot of opportunity to leverage that as a sourcing platform to, save these recruiters time, or maybe they're too small, but they don't have that resource in house. So I think fundamentally you're better off, targeting the practitioner lower level and finding niches, which are maybe hard to, find good talent for. Maybe it's a niche that there's just a lot of people trying to apply for the job. So there's a lot of noise, and, really trying to find vetted candidates is difficult. Or maybe it's not necessarily there's a lot of people applying for it, but maybe it's a very unique job that is a newer thing, like an AI prompter, for instance, right? If you go to a legacy company, they're not going to necessarily know how to hire for that. So maybe your solution can target those less common, newer, roles that they could use support with. So seems like a cool. I mean, like that industry is definitely underserved in various ways. So AI definitely has a role in there, but couldn't tell you exactly what role that should be.
Awesome. Yeah, thanks so much. The last question is, to build a great company from startup, what matters more, a strong and visionary leader with a product or service that's unclear or unproven, or a great product or service with an average team and founder?
Wow, it seems like a random interview question, like a mind twister. I mean, you know, I guess ultimately you're kind of asking the question of it's the product or is it the leader, right? And I would say, you know, one of the biggest reasons teams fail is not necessarily that they don't have a fully developed product or even that the product is value additive, but it's just the inner workings of, well, oftentimes it's sometimes running out of money, which is fundamentally an issue in general. But the other is the team you're working with, right? You know, at the end of the day, like if you can't work well together as a team, then that can lead to a lot of inefficiencies and ultimately inhibit you scaling. So I would say, you know, building a quality team that is, you know, around the product or service you're trying to offer, and they have balanced perspectives and diversified views and expertise, is going to set you up and is critical for, you know, developing that founding team. And then you obviously want to validate your product. Like no company that doesn't have a strong, you know, service or product is going to do well. But I will say in terms of getting investments like early on, it will definitely be more so, you know, having this strong team is going to be value additive, because when it comes to, you know, investors, early stage companies, your product's not far enough along. And so they're investing in the team, not the product. So I would say focus on team now. And then as you start to, you know, get a little bit more further along, you can really start to refine the product and then have the dynamic duo there.
Yeah, thanks for answer. I agree. Having good team and strong visionary leader obviously helps you at early stages, but at later stages, in my opinion, you need proven product that delivers value to the market. 100% agree. Yeah, before we wrap up, a huge thank you to Will for dropping serious insights on building, scaling, and exciting trends in today's startup landscape. If there is one key takeaway, it's this: success in 2025 is about being intentional, like build lean, move fast, stay customer obsessed, be flexible, and surround yourself with the right team. And speaking about the right team, if you're looking to scale your startup and find your next role in the tech, or want to partner on cutting edge project, reach out to IdleSoft. We work with founders, operators, engineers who are building the future, and we would love to hear from you. And thanks again for joining us. And until next time, keep building smart and see you next time.
All right. Have a good one, everyone. Thanks for jumping on.
Bye.